What happens when a sitting US president ends the year by flexing military power, challenging the Federal Reserve, and claiming he has nearly solved the war in Ukraine? Welcome to the intersection of power, risk, and transition, where the headlines are loud, but the next move is still uncertain. Markets aren't collapsing, but they're not cruising either. Trump is tightening oil flows from South America, threatening Fed leadership, and framing 2026 as the dawn of a new American boom. Meanwhile, investors are eyeing today's housing data and Fed minutes with one eye open because no one wants to get caught leaning the wrong way going into January. By the end of this breakdown, you'll understand what Trump's end-of-year power messaging is really aiming to do, why today's pending home sales and upcoming Fed minutes could make or break the soft landing narrative, how oil and gold are moving in opposite ways despite shared geopolitical risks, and what the latest Bitcoin and Ethereum whale moves are signaling about early 2026 positioning. Let's get into it with nothing skipped and everything explained. As December winds down, the stock market is walking a thin line. Pending home sales data is due today, and the Fed's meeting minutes are expected Wednesday. These are the final puzzle pieces before traders lock in their Q1 positioning. Why are these two events so critical? Because inflation expectations Trump's year-end power play. Trump has ended 2025 with an aggressive, coordinated messaging campaign. First, he ordered a military-led quarantine of Venezuelan oil. The Coast Guard will block suspicious shipments for at least 2 months. That's not just a trade sanction, that's a show of force. At the same time, he welcomed Ukraine's Zelensky to Mar-a-Lago, claiming a 95% complete peace deal with Putin is on the table. Then he turned to the Fed. They are part of a bigger strategy. Trump is framing himself as the architect of peace abroad, growth at home, and power in global markets. But markets know better. They're reading the fine print. The Venezuela move squeezes energy supply. The Ukraine plan is thin on enforceability. The Fed attack signals pressure, not partnership connector. And this makes today's economic data even more critical. US pending home sales. Why does it matter? Because housing has been the silent casualty of the Fed's tightening campaign. If the data shows continued weakness, it reinforces the soft landing narrative and supports rate cut expectations. But a surprise to the upside, that could spook bonds and delay the easing timeline. We're also heading into the release of Fed minutes. The market wants a clear signal of dovish intent. Anything less could crack confidence in early Q1 positioning. Smart money is holding fire. Positioning is light. Liquidity is thin. But the implications are large. Strong housing data equals cautious pause in risk appetite. Weak housing data equals renewed bid in bonds, gold, and tech. Speaking of gold and oil, let's go there next, because their movements right now are anything but quiet. Gold is trading above $4,500. And it's not just about inflation anymore. The metal is being driven by three powerful forces. Geopolitical instability from Trump's Venezuela and Nigeria military moves fear of central bank politicization, weakness in labor, and consumer sentiment data. The idea that Trump can spark a global realignment while demanding rate cuts has triggered a shift toward hard assets. Add in today's housing data risk and the Fed's upcoming tone, and gold's safe haven appeal is solidified. Meanwhile, oil is range-bound. Prices are hovering around $60 despite growing conflict headlines. Why? Because supply isn't constrained yet. US production is steady, OPEC can't agree on cuts, and global demand isn't breaking out. Yes, Trump's Venezuela blockade adds a layer of tension, but so far the market isn't pricing in real disruption. Pending home sales data and global consumption trends will likely determine the next move. But while commodities are reacting to physical risks and policy shifts, the crypto market is making its moves on sentiment, ETF flows, and whales. Bitcoin just reclaimed $90,000. That's a big level, especially in a week of ETF outflows and holiday illiquidity. This tells us two things. 1. Institutions are done trimming for tax purposes. 2. New positioning for 2026 is quietly beginning Trump's demand for Fed rate cuts, and his muscular global stance are reviving Bitcoin's appeal as both a macro hedge and a high beta growth play. Ethereum is riding its own wave. Prices are closing in on $3,100, supported by whale accumulation and ETF optimism. Dormant wallets are coming back to life. Spot ETH ETF speculation is heating up, and technical sentiment has flipped bullish. If today's economic data disappoints, crypto could catch another bid. That's how sensitive this space has become to macro tone. Which brings us to the big question: how does all of this come together heading into 2026? To sum it all up, markets are cautiously optimistic, but waiting for confirmation. Trump is reshaping the narrative with energy, defense, and Fed pressure. Commodities are split. Gold is climbing, oil is stuck. Crypto is awakening, with BTC and ETH signaling early accumulation. This isn't a market driven by fear. It's a market driven by positioning, and every data point, tweet, or surprise from here forward can tilt the field. Stay sharp, stay flexible, and stay tuned. Follow Zay Capital Markets for clear, fast, and focused market insight every single day. We decode the story, you decide the move. Catch you on the next breakdown.